So you want to own a casino, a building full of people voluntarily handing you money around the clock, 365 days a year. No inventory to spoil, no product to manufacture, no service to deliver that costs you anything close to what you charge for it. Just mathematics working silently in your favor on every single bet placed at every single table, every single spin of every single reel, every single hour the doors are open. The house always wins. You've heard that. Here's what you haven't heard. The house always wins on the math. The owner doesn't always win on the business, and the gap between those two statements is where casinos are built, operated, leveraged to the hilt, and occasionally driven straight into bankruptcy by people who understood the odds perfectly and still got the business wrong. Let's start with what you're actually buying, because a casino is not one business. It is at minimum 4 or 5 different businesses running simultaneously under one roof. And the one that most people picture when they think of a casino, the gaming floor itself, is frequently not the most profitable part of the operation. There's the gaming operation, slot machines, table games, poker rooms, sports betting terminals. There's the hotel, which in a destination property can have thousands of rooms and run at occupancy rates that standalone hotels dream about. There's the food and beverage operation, from buffets to celebrity chef restaurants, which can generate hundreds of millions in revenue at a major Las Vegas property. There's the entertainment venue, concerts, boxing matches, comedy shows, which serves a dual function of generating ticket revenue and driving foot traffic to the gaming floor at the same time. And there's the retail operation, the shops and amenities that extract additional spending from guests who have already decided to be on the property. None of these businesses are optional in a competitive market. A modern destination casino that tries to run a gaming floor without a hotel, without restaurants, without entertainment, is competing with one hand tied behind its back against properties that offer all of those things. The gaming floor is what draws people to the building. Everything else is what keeps them there and extracts more value from the decision they've already made to show up. Before a single chip crosses a table, there's the matter of getting permission to operate. And this is where casino economics diverge from almost every other hospitality business in America, because the regulatory barrier to entry is unlike anything in the hotel or restaurant industry. Gaming licenses are issued by state gaming commissions and in some jurisdictions by tribal authorities, and the application process is one of the most thorough background investigations conducted anywhere in the American private sector outside of national security clearances. Every principal investor, every key executive, every significant lender to the project will be investigated personally. Their finances, their associates, their history going back decades. The investigation is not perfunctory. It has killed deals involving serious, sophisticated investors over issues that would be completely irrelevant in any other industry. And the license, once granted, can be revoked. The ongoing regulatory compliance obligation is permanent, expensive, and non-negotiable. In Nevada, a gaming license application for a major property can cost millions of dollars in legal and consulting fees before a single state fee is paid. In New Jersey, the Division of Gaming Enforcement maintains a permanent presence inside Atlantic City casinos. Regulators physically inside the building watching. In states with newer gaming markets, the license itself, separate from the physical property, can be worth hundreds of millions of dollars because the state limits the number in circulation. Buying a licensed casino in a limited licensed jurisdiction is not like buying a restaurant. You are buying the license as much as you're buying the building. Now let's talk about the building itself, because the capital requirements to build or acquire a competitive casino property are genuinely staggering. The Wynn Las Vegas cost approximately $2.7 billion to build when it opened in 2005. The Cosmopolitan of Las Vegas cost approximately $4 billion. The MGM National Harbor near Washington, D.C., a regional property in a non-destination market, cost approximately $1.4 billion. Even a regional commercial casino in a mid-tier market typically requires an investment of several $100 million to build competitively. And unlike a hotel, where you can add a few new rooms or renovate a floor without touching the core business, a casino's physical design is deeply integrated with its revenue model. The layout of the gaming floor, the placement of slot machines, the sight lines from the entrance, the distance between the front door and the nearest exit, the absence of clocks, and the management of natural light, All of these are deliberate engineering decisions rooted in decades of behavioral research about how people move through spaces and how long they stay. You do not accidentally design a profitable casino floor any more than you accidentally write a profitable mortgage contract. Let's talk about how the money actually works on the gaming floor, because this is where most people's intuition about casino economics goes wrong in an important way. The house edge, the mathematical advantage built into every game, is not a profit margin. It is a long-run statistical expectation. In the short run, at the level of individual sessions on any given day, results are volatile. A single high roller playing baccarat with a $3 million buy-in who runs lucky for 4 hours can turn a casino's entire day from profitable to negative for that table. The house edge on baccarat is roughly 1% on the banker bet. Over thousands of hands, that edge grinds out a reliable return. Over one night with one whale, anything can happen. This is why casino financial people do not talk about daily profit. They talk about theoretical win, the amount the house should expect to win over time, given the volume of bets placed and the mathematical edge on each game. And they compare it constantly to actual win, what really happened. When actual win runs significantly below theoretical win for an extended period, it is not necessarily a sign that something is wrong with the business. It may simply be normal, short-run variance. But when it persists month after month, it usually means the high roller segment, the players the casino is comping hotels and private jets to attract, is running cold. And cold high rollers are expensive because the comps don't stop when the cards go against the house. Here's the counterintuitive financial fact about high roller, or what the industry calls premium, or VIP, gaming. These players generate an enormous percentage of a casino's theoretical win. At some major Las Vegas properties, the top 1% of players by volume can represent 30 to 50% of total gaming revenue on paper. But those same players receive comps, complimentary hotel suites, private transportation, meals, entertainment, credit lines, and other benefits that can run into tens of thousands or hundreds of thousands of dollars per visit. The actual margin on a VIP player, after all comps are accounted for, can be significantly lower than the raw gaming revenue suggests. And a VIP player who wins big and leaves, or who simply decides to take their action to a competing property, takes all of that theoretical win potential with them when they go. Slot machines are the other side of this story, and they are worth spending time on because they are fundamentally different from table games in ways that matter enormously to the business. A slot machine plays against the house edge on every spin without the casino needing to staff a dealer or pay a pit boss to watch the table. The theoretical hold percentage, the percentage of all money wagered that the machine retains over time, is set in the machine's software and regulated by the Gaming Commission. Modern video slots are calibrated to return somewhere between 85 and 98% of wagers to players over time, meaning the house retains 2 to 15% of every dollar cycled through the machine. In a regional casino where the slot floor might cycle hundreds of millions of dollars in wagers per year, that hold percentage represents an enormous stream of revenue that requires almost no variable labor to generate. This is why the composition of a casino's revenue mix matters so much to its operating economics. A property that generates 70% of its gaming revenue from slots is running a very different business from one that generates 70% from table games, specifically baccarat played by high rollers. The slot-heavy property has lower revenue volatility, lower labor intensity on the gaming floor, and more predictable month-to-month results. The baccarat-heavy property can have spectacular months and catastrophic ones, and managing that volatility while maintaining the high roller relationships required to keep the baccarat tables full is itself a specialized and expensive business function. Now let's talk about the hotel, because in a destination casino property, the hotel is not a side business. It is a strategic weapon. A casino hotel room rented to a gaming customer serves a fundamentally different financial purpose than a room rented to a business traveler at a Marriott. The casino hotel room is a mechanism for extending the amount of time a gaming customer spends in proximity to the gaming floor. Every additional hour a guest spends on the property is an additional hour in which the house edge is working in the casino's favor. This is why major casino hotels will offer their best gaming customers deeply discounted or complimentary room rates. The room cost is an investment in additional gaming time, and the expected return on that investment is calculated with the same mathematical precision as the house edge itself. A casino that comps a high roller, a $300 suite for 2 nights, is spending $600 to keep that player in the building for 48 additional hours. If that player wagers $200,000 over those 48 hours and the house edge on their preferred game is 1.5%, the theoretical return to the casino from the additional time is $3,000. A $600 investment with an expected $3,000 return is, mathematically, one of the better investments the casino makes all week. The food and beverage operation introduces a different economic logic entirely. At the largest destination properties, celebrity chef restaurants and high-end bars are not primarily in the business of selling food and drinks. They are in the business of creating reasons for guests to arrive, extend their stay, and feel that the overall experience at the property is worth returning to. Some of the most famous restaurants in Las Vegas operate at thin margins or even losses on the food and beverage side itself. And the casino absorbs those losses because the restaurant is a marketing asset that cannot be easily quantified but is very real. The guest who decides to stay at your property rather than a competitor's because you have the restaurant they wanted to visit is a guest whose gaming, hotel, and ancillary spending flows to you rather than to your competitor. The restaurant's profitability on its own income statement is not the number the casino's management team is focused on. Let's talk about operating costs, because they are substantial and they are structured in ways that create meaningful risk in down cycles. Labor is the largest single operating expense in a casino, just as it is in hotels and restaurants, typically running somewhere between 30 and 40% of total net revenue. But casino labor has a unique characteristic. Much of it cannot be reduced quickly in response to declining gaming volumes. Dealers have to be at the tables when the tables are open. Security has to be on the floor whenever the floor is operating. Surveillance has to be running continuously. Regulatory compliance staff cannot be furloughed because gaming volumes are down. You cannot run a casino at 60% of its labor force the way you might be able to temporarily right-size a manufacturing plant. The minimum viable staffing level for a competitive casino operation is high, and it doesn't compress much even when revenue does. Then there is the tax structure, which is one of the most significant financial differences between a casino and almost any other hospitality business. State gaming taxes are assessed on gross gaming revenue, meaning the total amount the casino wins from players before any operating expense is deducted. Gaming tax rates vary enormously by state, from as low as 6.25% in Nevada to as high as 50% of gross gaming revenue in some jurisdictions. In states with high gaming tax rates, the economics of the business are fundamentally different from what they are in Nevada. A casino in a 50% tax state that generates $100 million in gross gaming revenue starts the year with $50 million already gone to the state before a single employee is paid, before a single meal is served, before the electricity bill for the slot floor is settled. This is why the regulatory and tax environment of the specific jurisdiction is arguably the most important factor in casino economics. More important than the property design, more important than the marketing strategy, more important than the quality of the gaming product itself. Here's a structural feature of casino economics that rarely gets discussed outside the industry. Chip float. When a player buys into a table game with cash or credit, they receive chips. Those chips represent a liability of the casino to the player. If the player walks away from the table with chips in their pocket, the casino owes them that value. But if the player never redeems the chips, that liability eventually gets written off as income. Across a major casino operation, the float of outstanding chips and unredeemed gaming credits at any given moment can represent millions of dollars. It is a short-term liability that tends to be remarkably stable and predictable in aggregate, making it a useful source of working capital for the business. This is not the kind of financial detail that shows up in most descriptions of how casinos work. But for operators managing cash flow across multiple properties, understanding and optimizing the float is a real part of financial management. The debt structure of a casino is worth examining carefully because it is different from most real estate businesses in ways that create specific vulnerabilities. Casino properties are typically financed with significant leverage. The combination of high construction costs, long licensing timelines, and the competitive necessity of building to a high specification means that most new casino projects open with substantial debt loads. The problem with high debt in a gaming business is that gaming revenue is more volatile than almost any other form of commercial real estate revenue. A hotel can lower its room rates to maintain occupancy during a downturn. An office building has long-term leases that continue paying rent regardless of the tenant's short-term financial condition. A casino's revenue can swing dramatically based on the luck of a small number of high-value players over a short period, and the debt service doesn't move regardless of what the baccarat tables did last month. This is what happened to several major Las Vegas casino projects during the financial crisis of 2008 and 2009. City Center, the massive development on the Las Vegas Strip that included the Aria Resort and Casino, cost approximately $8.5 billion to build, making it one of the most expensive privately financed construction projects in American history. When the project opened in December of 2009, Las Vegas gaming revenue had declined sharply from its peak as the recession reduced both business travel and discretionary leisure spending simultaneously. The project's debt load incurred during the construction years was enormous. The development company had to reach a restructuring agreement with its lenders almost immediately after opening. Station Casinos, which operated a network of locals-focused casinos in the Las Vegas suburbs, filed for Chapter 11 bankruptcy in 2009, carrying approximately $5.5 billion in debt. The Revel Casino in Atlantic City, which cost approximately $2.4 billion to build, opened in 2012 and filed for bankruptcy twice in 2 years before closing permanently in 2014. The building sat empty for years, eventually selling for $82 million. Roughly 3.5 cents on the dollar of what it cost to construct. These failures were not caused by bad casino management in the conventional sense. The games were honest. The odds were calibrated correctly. The regulatory compliance was adequate. The businesses failed because their capital structures could not survive a period of reduced revenue. And in a business where the revenue is as volatile as casino gaming revenue can be, the margin for error in the debt structure is very thin. Now let's run the actual math on a regional commercial casino the way an operator has to run it. Take a mid-tier property in a regional market, not Las Vegas, not Macau, but a competitive gaming destination in a state with a meaningful but not dominant gaming market. The property has 1,200 slot machines, 40 table games, a 400-room hotel, 3 restaurants, and an entertainment venue. Its gross gaming revenue in a strong year is approximately $300 million. The state gaming tax rate is 20%, which is on the moderate side for the industry. That's $60 million off the top before the first operating expense. Net gaming revenue after tax is $240 million. Add hotel revenue, food and beverage, entertainment, and parking, and total net revenue might approach $320 million for the year. Against that revenue, subtract labor at 35% of net revenue, roughly $112 million. Subtract non-gaming operating costs, food and beverage costs, hotel costs, maintenance, utilities, marketing, and administrative overhead at another 30%, roughly $96 million. What remains before interest and depreciation is approximately $112 million in operating income, an operating margin of roughly 35% of net revenue, which is a genuinely healthy business in good conditions. Now, the debt service. If the property was built for $600 million and financed with $400 million in debt at current interest rates, annual debt service might run somewhere between $35 and $50 million. Subtract that, and the free cash flow available to the equity owners is somewhere between $60 and $75 million in a strong year. Against a $400 million equity investment, that's a return of 15 to 19%. Which is attractive but not extraordinary for the risk profile. Now the bad year. A new competing casino opens in the same regional market. Your gaming revenue falls 15% as players migrate to the new property. Your gross gaming revenue drops from $300 million to $255 million. The tax bill shrinks proportionally, but so does the net revenue base. Meanwhile, your labor cost doesn't fall 15% because you can't reduce your minimum viable staffing level by that much. Your debt service doesn't move at all. Your marketing spend actually has to increase because you are now fighting to retain customers you previously took for granted. Your operating income in this bad year might fall from $112 million to somewhere around $60 or $70 million. After debt service, the free cash flow that was $60 to $75 million in the good year might be $15 to $30 million. The equity return that was attractive at 15 to 19% in a strong year is now somewhere between 4 and 8%. Still positive, still technically profitable, but thin enough that a second bad year, another competitor opening, or a macroeconomic shock reducing regional consumer spending further would put the debt service coverage ratios in a range that makes lenders uncomfortable. This is the structural reality of owning a casino that the mathematics of the house edge obscures when you look at it from the outside. The house edge means the gaming floor is profitable over time. It does not mean the business is resilient. The edge operates on the money that flows across the tables and through the machines. It does not operate on the interest payments, the tax bills, the labor contracts, or the capital structure decisions that were made years before any chip was placed on any felt. So does owning a casino actually work as a business? The honest answer is that it has worked spectacularly for some operators and destroyed others who made what looked like reasonable decisions at the time. The difference between the operations that compounded wealth for their owners over decades and the ones that ended in bankruptcy courts is almost never the quality of the gaming product. It is almost always the capital structure, the tax jurisdiction, and the competitive landscape of the specific market at the specific moment the debt was taken on. A casino isn't really a gambling business, even though every surface in the building is designed to make you feel the gambling is the only thing happening. It is a real estate and hospitality business where the gaming floor serves as the customer acquisition mechanism that fills the hotel, packs the restaurants, sells the concert tickets, and keeps millions of people per year choosing this building over every other way they could spend their entertainment dollar. The edge on the games is real, and it is the foundation of the entire financial model. But foundations only matter if the structure built on top of them is sound. And in this business, the structure built on top of a mathematically reliable foundation has failed more spectacularly, more expensively, and more publicly than in almost any comparable industry. Because in a casino, you can be right about the odds and still be wrong about the business. And being wrong about the business in this industry costs a great deal more than the price of a single bad bet.